Good afternoon, everybody, and welcome to the Fintech Nexus Crypto Winter podcast series. That's quite a mouthful, but that's what we're doing here. We're interviewing people throughout the crypto ecosystem and talking to them about what the crypto winter means for them, what they think it means for finance and the future. Joining me today is John Sun, who is the CEO of Spring Labs. How are you doing, John?
Hey, how's it going, Peter? Thank you so much for having me on the program here.
Okay, my pleasure. So let's kick it off by just letting listeners know a little bit about Spring Labs. Give us a minute or so on the background there.
Yeah, absolutely. So Spring Labs is a data and cryptography company that primarily helps build the future of data exchange and really helping financial institutions share sensitive consumer data with one another. As a part of it, we do a lot of work in blockchain simply because we think that's where the future uses of data are going. And we certainly want to transform the way that data is being done today, but we also want to transform the way that data is exchanged in new ecosystems and new paradigms like blockchain, for instance, where we really do see a lot of financial services going. My background has been more in traditional fintech. I was the founder and chief risk officer at Avant. And prior to that, I spent some time with Y Combinator building fintech and personal financial management software.
Okay, so let's maybe we could just, before we get into the meat of the discussion, talk about the different areas maybe that Spring Labs is operating in. I know you sort of started with a product for lenders. That's where you said it spun out of Avant, which was a consumer lender. So maybe talk a little bit about that product, and I know you spun out Quadrata, which was in the news this week actually. But tell us a little bit about the products.
Yeah, absolutely. So Spring Labs, as I was saying, is primarily a technology and cryptography company focused on changing the way that sensitive consumer data is stored and exchanged. Your data is out there right now with kind of minimal amounts of security being exchanged by lenders and financial institutions and credit bureaus and all of these players. And that's why you see a lot of these kind of data loss type events. What we do is build secure tokenization technology and in-house cryptography to basically help banks and financial institutions secure that data and exchange it in a more responsible way. The primary ways we do that are, like you said, through building actual products for lenders, typically in the form of data exchanges. So these are data products that help lenders exchange a very specific type of data for some lending or onboarding activity. For example, we can help lenders exchange information about someone's identity or someone's income stream or someone's a fraud history. In addition to that, we also deploy our technology directly. So we work directly with some of the largest credit bureaus and financial institutions out there to use our technology as a part of their infrastructure, deployed within their firewalls and within their infrastructure to help with things like data minimization, but also with things like closed loop data exchanges, where we can tokenize sensitive consumer identifiers and do entity resolution from within these bank systems, which makes it easier for them to secure the data internally, but also to exchange it with their partners without sending consumer information across the wire.
Right. And so just to be clear then, you started this company. I remember we chatted many years ago when you were just kicking it off, and it was built from the ground up with blockchain technology as its core.
Exactly.
Has that maintained that sort of the way you've done this? Has that maintained through over the years?
Yeah, the data exchange still continues to be powered by blockchain technology. We do think blockchain technology is still the most efficient way to address many of these kind of multi-participant systems where there isn't perfect trust between the participants. Over the years, we've kind of seen enterprise blockchain projects kind of come and go. I think a lot of what we do is still focused around bringing real use cases to lenders, financial institutions, rather than around the underlying technology itself. But of course, we do believe that it is one of the most efficient technologies for handling some of these multi-participant type ecosystems. Now, like you kind of mentioned earlier, We have started getting more into public blockchain in recent times. I think the rise of kind of DeFi over the course of the last 24 to 30 months has really pointed out that there's massive needs for financial services, traditional financial services types products on blockchain. And as a result, we have been focusing some of our efforts on products built on top of traditional public blockchain layer 1 networks, as well as geared towards more of a Web3 and crypto-centric kind of market. And Quadrata, which is a on-chain identity passport, identity and compliance passport, is one of the first products that we spun out of Spring Labs entirely. So they were in the news this week as kind of having just closed a round led by Dragonfly. So I think we're pretty excited for the team there, and we'll continue to kind of be partners and supporters of theirs as they continue to grow.
Right. So you got a pretty interesting vantage point of the industry, because you're sort of coming at it from traditional fintech, shall we say, but really immersed in the technology of DeFi. And so maybe you could give us some sense of how, like, the last few months with some of the meltdowns we've seen. Obviously, the price of crypto is down dramatically, but more than that, there seems to be like this, the trust that people had in many of these crypto companies has been broken. But so how's that impacted what you're doing at Spring Labs? Or how's it impacted sort of how your conversations are going with traditional financial institutions?
Yeah, great questions, all great questions. I'll kind of address in a couple different steps here. But I think, over the past couple of months here, it's, really reinforced our thesis of nothing else. And I think our thesis has always been very technology driven in this space. It's not so much, which tokens are going to do well and, what's the next thing to pump or go to the moon or anything like that. My thesis in the space has always been, heavily technology driven, in the sense that, my team and I were really a big part of the early fintech kind of 1.0 boom, where financial services startups really started taking products away from banks and showing banks that they can do it better than the banks. And I think a large part of that was technology. It was having access to much easier ways to build, to rapidly iterate, having much more modularity in technology and componentization, essentially, which allows you to assemble a fairly sophisticated financial services product without having to build every single piece yourself. And I think that's only accelerated in the 6 or 7 years since Avant had started. If you look at the fintechs today, I mean, a lot of these guys has access to kind of world-class, underwriting systems and data pipes and payment transactions and payment processing without having to, build any of this stuff. They're essentially orchestration layers of all of these various other types of products. And that's what allows them to really stay focused on delivering kind of customer value and delivering specific customer solutions, while at the same time not having to worry about the underlying infrastructure. And I think that's exactly what blockchain does, DeFi does to financial services to kind of the nth degree. It's really that modularization and componentization built in at the ground level through what's called composability of smart contracts, basically allowing you to layer interactions from many different smart contracts to create these pretty sophisticated transactions, and then to clear transactions atomically, which means that if any of the components of that transaction fails, it essentially unwinds the entire transaction back to some beginning state, which again helps you avoid a lot of the issues that you kind of see in traditional financial services. I love using this example. I know it's a bit it's a bit kind of inaccurate depending on how you look at it, but I think it captures the spirit of why I think DeFi is going to be a huge force for financial services in the future. Which is, if you look at a sophisticated, core lending platform or core banking platform or what have you, these things are written in, hundreds of thousands or millions of lines of code. When we built the Avant system, I mean, the thing was hundreds of thousands of lines of code to, a million lines of code. If you look at some of these more sophisticated DeFi products, like Uniswap, for instance, Uniswap is written on thousands of lines of code, less than 5,000 lines of code.
Wow.
And yet it's handling an amount of transaction that rivals traditional financial services systems, and it's doing it in a way that has kind of proven that it could scale, that it's reliable, that it's resilient. And I think if you were the next generation of fintech builders looking to build in this space, and you were trying to decide between traditional financial services rails or DeFi, and the opportunity kind of presented itself in both arenas, you'd take a serious look at building on DeFi instead of traditional financial services rails.
Interesting. So you're fine. What you're saying then, from can I take that as implying from that, are traditional banks that you're talking to, are they having second thoughts about dealing with blockchain-based companies, or is that not happening?
It's a good question. Our traditional bank products are more, bank centric. They really are geared towards kind of bank level compliance and bank level security. So when a bank works with us, it's not the same as saying, hey, like we're gonna work with some Web3 or DeFi project on public blockchain. I think what I'm more saying is that the next generation of products we built are likely to be built on DeFi rails, simply because it's so much easier for fintech entrepreneurs to kind of build on those rails rather than traditional financial services.
Right. Okay, so for those people watching this live, if you have a question for John, feel free to hit the Q&A button and we'll try and get to it before the end of the show. Okay, so given sort of what has happened, I'm curious because you've got a background in the lending space, and we've seen the area of crypto that is really being hit hardest, apart from the sort of the Terra collapse, which I think was a specific kind of thing, but across it's the lenders, the centralized lenders that are really feel like have been struggling the most. And as someone who knows the lending space well, what do you make of the challenges these companies are facing, and some of them look like they're not going to make it as a going concern?
Yeah, I think that's also kind of a great question. I think it's anyone's guess exactly what happens to this space. But it's kind of no secret, and I've been saying this for a while, that there's a lot of correlated risk in the crypto space today. And frequently the previous 6 months before the last 3 months, like all of 2021 and a lot of 2020, I think folks were telling me like, hey, there's so much kind of free yield to be had in DeFi, right? You can stake your money in a stable coin and get like 12, 14, 15, 20% yields. And I think what was surprising to me is that folks who should have known better were kind of presenting this scenario as risk-free yield, as saying, hey, it's a stable coin, there's no underlying risk, it's deployed in a smart contract, so it must be okay. I think what we've kind of seen through the Terra collapse is that clearly there is a lot of correlated risk and corner cases within the DeFi ecosystem, and that's normal. There's really kind of no free lunch, I believe, in over a long period of time in any of this. What is interesting though is that now that we have seen DeFi yields come down to earth and really reflect what lower risk or risk-free yields should be, if you look at kind of guaranteed returns on some of these DeFi platforms today, they're kind of no longer like 10, 11, 12, 15%. It's more like 2, 3, maybe 4%, right? Mm-hmm. And what's really cool about that is that I think this is the dynamic that's going to allow the next generation of financial services products to grow. At the end of the day, when there is perceived risk-free yields of 12, 13, 14%, there's no reason to access off-chain yield, for instance, right? Because in the off-chain world, you might be getting a fraction of that. But now when all of a sudden yields are 2, 3, 4%, if a product can kind of bring the chain off-chain yields of 7, 8, or 9%, all of a sudden it might become much more interesting. So what it really did was it opened up the problem space quite a bit more for the next generation of DeFi products who are actually going to build meaningful products that really affect kind of real world and pull from real world financial services as well as push back to real world financial services.
Yeah, that's a really interesting point, John. I hadn't sort of thought about it in that way. That's really interesting. So, I want to talk a little bit, if I can, about your partnership with TransUnion. I know you spoke on the lender stage at our recent event with TransUnion, and talking about identity and bringing that on within a DeFi system. So maybe just describe a little bit about what your relationship is like with TransUnion, and has there been any change in that given the events of recent weeks?
Yeah, I think our relationship with TransUnion has always been very close. They were a lead investor, or the lead investor in our most recent round last year in our Series B. They hold a board seat on our board, and they've been amazing, just simply amazing partners to build with. I have kind of said this previously and continue to stand by it. I really do think TransUnion is one of the most forward-thinking credit bureaus kind of out there. Just given how much of this space is really around protecting existing business rather than going out and looking for new avenues to kind of create new possibilities and kind of new value. So from that perspective, I think hats off to the TransUnion team. They've really kind of gone above and beyond to really understand what the next dynamics and next paradigms are likely to be kind of in the data space. And to that end, we announced this a while ago, but we are going to be the first to bring consumer credit scores to a blockchain setting where a DeFi or a smart contract application can, through the Quadrata passport, directly operate on or decision on or use a piece of consumer permissioned credit data in the form of kind of a credit score. Hold on for 1 second here.
Okay, we'll looks like John's got some background noise happening there for those that are listening. We'll just give him 1 sec.
Yeah, very, very, very sorry about that.
No worries.
Yeah, so we'll be, we'll have the first to bring consumer credit scores to chain. And I think the team has been extremely helpful in kind of navigating the internals of how to get that done from kind of a regulatory standpoint, from an organization standpoint, et cetera.
Right. And that, I tell you, I think the technology you're building there is one of the most interesting applications that I've seen, because what we talk about, there's the DeFi world, there's the traditional finance world, particularly when it comes to consumer credit, which, I mean, obviously the fintechs have done a great job making things a better user experience, but the two worlds have really been separate, where people have been borrowing money on Compound and Aave now for years. And we haven't really seen much in the way of sort of a cross-pollination. But what you're providing, is a product that can bring some of the knowledge and some of the advantages of the traditional credit world into DeFi. And I mean, I think I personally think it's one of the most exciting applications of it. And so I guess maybe talk a little bit about how, what's the roadmap look like for, when am I going to be able to connect my MetaMask wallet and have my have my credit sort of credentials permissioned into that wallet?
Yeah, so I think we are planning to release something tentatively before year end. So we're working with kind of the teams on both sides to really get that lined up from kind of a process as well as technology perspective. So fingers crossed, sometime in that time frame, we'll be able to kind of get this data in the hands of the next generation of financial services builders that's building on top of DeFi. And the goal from there is really to expand data offerings, both in conjunction with folks like TransUnion, as well as bring other off-chain data sources to make them available for on-chain consumption through kind of Web3 and smart contract applications.
Right. And then what about the banks that, banks have been participating, in consumer loans originated by fintechs for, a decade or more now. I'd love to kind of, maybe you could just take a step back and not necessarily look at this particular use case, but I'd love to sort of get your perspective on how banks kind of can enter the DeFi world. And some people talk about, well, let's go to a Web 2.5 world. But what you've got is really bringing your technology into a really a native Web3 world. But how do we get from Web 2, where banks, and obviously TransUnion has obviously worked with all the major banks, how do we get from that world into a Web3 world?
Yeah, I think it's a good question, and I think it's going to be kind of a meet in the middle between the Web3 world and kind of the traditional kind of banking sphere. And I think there's going to be products on both sides that start, taking it towards that middle ground. For example, one of the ideas that we've been exploring is essentially this idea of how to lower collateralization limits by using some amount of off-chain consumer identity or credit data to start creating this ecosystem where there's a small amount of trust and a small amount of reputation being built over time. I don't think it's from day one going to be like directly jumping headfirst into unsecured consumer credit loans, for instance.
Right.
As we've kind of talked about before, there's a large amount of learning that's gone into what the consumer unsecured lending space looks like today, right? And a lot of money spent learning along the way. So for Web3 to kind of replicate that is not a matter of kind of taking a single piece of data or taking a score or anything like that, and all of a sudden being able to give out $10,000-$20,000 loans to consumers on chain. I think it's going to be much more of an iterative process where we are going to see small steps like under collateralization, extensions of small amounts of credit to eventually build towards that kind of blockchain native credit world. Now, as far as how banks can participate in that world, also a good question. I think the meat in the middle from the bank side is more going to be through replacing some of the seemingly kind of back-end functions that kind of exist at banks with equivalents in kind of Web3. One of the more exciting ideas that we've kind of heard recently is on-chain securitizations. This idea that maybe one day, hopefully one day soon, financial services firm or bank would be able to kind of run a entire end-to-end back-end securitization process against the DeFi pool, rather than going through kind of a traditional investment bank and having them kind of sell a particular offering. Now, obviously, there's a lot of questions in the way, a lot of regulatory hurdles, but I think that could be a more near-term way for banks to interact with the Web3 world, rather than, again, something like offering a consumer product directly from day one on Web3.
Right. So do you think, is KYC coming to Web3, and is it, and I mean, what's it going to look like? I presume you have a pretty strong view on this, given that that's kind of what some of the things you've been focused on. But what will it look like for KYC in DeFi?
Yeah, I think that's something that kind of keeps us awake at night as well, just because we've made several bets in this space that we hope are correct bets in this space, or we think are correct bets in this space at least. To answer your first question, I think yes, absolutely. As DeFi kind of grows to trillions of dollars and then tens of trillions of dollars of value, it's just hard to imagine that it would kind of exist outside of traditional financial services regulations and laws. So you're going to kind of see a mean reversion there, where it starts kind of looking, or at least it's treated a lot more like traditional financial services products. As far as what KYC is going to look like, I mean, the worst possible case scenario is it looks exactly the way it does in the off-chain world, because then that means we would have learned nothing from all the mistakes that we made in the off-chain world. I think, taking small baby steps, I think Quadrata is kind of one of these good steps towards designing a KYC and the identity system that looks like it kind of is aware of the last 20 years of technological development, rather than something that still happens in the 80s, which is a lot of traditional off-chain verifications and KYC and AML. And I think it comes to a few things that hopefully is going to be the case. I think number one, user control. I think user control of their own identity, maybe not user ownership or self-sovereign from day one, even though that's the eventual goal. but at least user permissioning, knowing who's using your data, knowing how they're using it, I think is extremely important. I think number two, instilling more security through pseudo anonymity, I think is important, rather than everyone using their social security numbers or names or dates of birth as identifiers. We should switch to systems that use tokenized pseudonymous identifiers, which, in the event of a data loss is a lot less damaging than losing someone's, only method of identification through kind of a name, social security number, date of birth pairing. And I think, it should hopefully be a system that introduces less friction for the consumer, that's less painful for the consumer to use to kind of interact with financial services products down the road.
Right. Okay. So then can you maybe we can close with this. I'd love you to sort of, paint a picture for us if, assuming that DeFi continues to grow and the technology that it continues to get more trusted and there's more products like yours, obviously there's many things that can be brought from the traditional world into the DeFi world. I'd love you to sort of paint a picture for us, if you will, of what it could be like in a decade where we, how we're going to potentially, move around, how we manage our financial life, and what role DeFi will play.
Yeah, absolutely. I think that's a great question. And I think hopefully for most consumers, what DeFi becomes is a invisible backend to kind of their financial lives, in the sense that things are just more user-friendly, things are just easier. You don't, as a consumer, day-to-day think about banking rails, just like you wouldn't think about DeFi rails in the future, hopefully. But what it means is that there's more fluidity, essentially, in the way that you kind of manage your financial life. I mean, you can certainly kind of imagine a future where the next generation of neobanks or challenger banks are built on DeFi backends instead of traditional banking backends, right? And you would interact with them through a hosted or a custodian wallet, depending on what the structure is, and you're able to seamlessly, through composable smart contract interactions, provide money management solutions or insurance solutions or investment solutions, all on top of this platform that is kind of a neobank built on top of DeFi. And you as a consumer, again, just like you don't think about banking rails today, you're not going to think about DeFi rails.
Right.
But what it's going to look like is a lot easier for you to interface with and consume financial services products, essentially the same way that you interface and consume kind of social media products today, with that level of kind of ease and flexibility.
Well, it's going to be interesting to see how that plays out. And John, I really appreciate you coming on our Crypto Winter podcast series, where we are going to continue the conversation. We'll be back actually tomorrow with the very next episode. And just a reminder, we also have our London event, Merge, which is all about the intersection of fintech, banking, and Web3. Make sure you go to fintechnexus.com to check that out. Anyway, thanks a lot, John. Thank you everybody for watching and for listening, and we'll catch you next time.